All right, so what we're diving into today is an analysis report that really zeroes in on the recent Nasdaq weakness.
Right.
It's using Oracle's earnings miss as the main catalyst and framing it as a short-term trading opportunity with the leveraged ETF, SQQQ.
And the focus is just incredibly sharp. I mean, the strength here is obvious from the get-go.
Oh, absolutely.
You have this precise identification of a catalyst, and then it's coupled with really actionable levels, that $67.13 trigger, the hard stop at $65.50. This is clearly from someone who knows how to spot and execute a very specific, high-risk signal.
No doubt.
So our job now is to make sure the delivery system for that analysis really maximizes its credibility.
That's the perfect way to put it, and it brings us to our first key area, which is all about that delivery, specifically how the tone of the report affects its authority.
Elevating the credibility of the detailed technical analysis requires adjusting the overall presentation style of the report.
The report uses what you might call a high-energy tone.
That's a good word for it.
The language is urgent, sometimes a little hyperbolic. We see phrases like, get ready to profit.
Right, or calling SQQQ the beast itself.
Exactly. And then it closes with a sort of marketing sign-off like, smash that like button.
And look, I get why that tone is used. I really do. It's designed to grab attention, to energize the user in what's a very noisy financial landscape.
Of course.
But the weakness is that this high-energy delivery, it clashes. It clashes directly with the objective, very sophisticated metrics that are being provided here.
It's a real mismatch.
The technical setup, watching that $67.13 50-day moving average, that is institutionally robust stuff. The language around it, though, it could potentially reduce the report's perceived seriousness, especially for an expert audience.
It really could. I mean, when you present analysis that is this specific, we're talking down to the penny on a major index signal. You are making a surgical argument.
A surgical argument, I like that.
And if the packaging feels like a late-night infomercial, even the absolute best analysis just loses some of its authoritative sheen. The tone simply doesn't match the sophistication of the trade itself.
Agreed. The mismatch is jarring. So, the suggestion for improvement here is pretty straightforward. Recalibrate the tone to better reflect that objective, data-focused analysis.
Let the numbers do the talking.
Exactly. Aligning the language will lend so much more authority and seriousness to the setup. The words need to match the precision of the trade signal.
And this is very actionable right from the opening line.
Immediately.
Instead of that high-octane opener, "Good morning, traders. If you're seeing red, don't panic. Get ready to profit." We should establish the analytical framework right away.
We need to respect the expert user's time. So, a concrete example of this change would be shifting to an opening that frames this as a measured assessment of, say, structural risk.
Something like?
Maybe reviewing current market volatility, the structural implications of recent Nasdaq weakness, and the short-term potential for the ProShares Ultra Pro Short QQQ.
See, that immediately signals that I'm about to engage with a structured analysis, not a market pep talk. It sets the expectation for deep quantitative substance to follow.
And it reinforces the value of those technical levels. If you start with a sober assessment, that $67.13 signal feels like a critical line in the sand. If you start with hype, it just feels like one suggestion among many.
That's a great point. The tonal adjustment ensures the excellent underlying work isn't undermined by its own narrative. It builds trust.
It really does.
Okay, so if we've covered the delivery, let's pivot to the logic that's supporting the trade. I'm talking about the connection between that catalyst and the broader index movement.
Yes, let's dig into that. Strengthening the causal chain between the singular Oracle earnings miss and the broader Nasdaq 100 index movement would improve the logical foundation of the trade setup.
The report does a good job identifying the market stressor. It correctly points to Oracle's miss on revenue and cloud sales, the 12% stock drop.
And how that pulled down NVIDIA and Broadcom in what it calls sympathy sell-offs.
Right. And observing that ripple effect is necessary, but here's the weakness.
Go on.
For a trade that relies on the entire Nasdaq 100 falling hard enough to justify a leveraged short ETF, the connection between a single stock event, even a major one, and the index as a whole needs more quantitative support.
Right. Just observing general sympathy isn't quite enough. You're making a claim that Oracle's stumble is the trigger for a broader correction.
And that's a pretty significant leap in logic. It needs more backing for an expert reader. It's that classic, so what question.
Exactly. Why this event? Why is this the one that kills the trend? The index is massive. Oracle is important, sure, but it's not the single structural anchor.
We need to demonstrate that this one event hits a disproportionate number of high-weighted stocks in that QQQ complex.
That's it. So the suggestion is to incorporate a brief, quantified view of how much this Oracle event and the sector fears actually impact the Nasdaq 100 structurally.
Show, don't just tell.
Show why the weakness isn't just anecdotal, it's mathematical.
And one of the quickest, most actionable ways to do this is to just show the math. As a concrete example, you could briefly state the approximate weighting of Oracle, NVIDIA, and Broadcom within the Nasdaq 100.
Even a quick percentage range would help contextualize the severity. It translates that feeling of fear into actual index points.
Totally.
Or you could look beyond just the individual stocks and focus on the sector. The Oracle miss fractures the enterprise, cloud, and software space.
Ah, that's a good angle.
So referencing a relevant subsector index like a major cloud computing index and showing how that moved relative to the broader QQQ after the news, well, that would demonstrate why this specific stumble is big enough to start that breakdown.
That's critical. It grounds the macro thesis that Nasdaq weakness equals an SQQQ opportunity in something measurable and structural.
Right.
Without it, the argument kind of relies on a subjective observation of sympathy. With it, the report establishes a verified mechanism for index stress. It validates the whole decision-making process.
And it transforms the analysis from just a good trading idea into a structurally validated authoritative thesis, which is what you need when you're recommending a leveraged instrument.
Oh, speaking of leveraged instruments, let's pivot to our final critique. And this one is maybe the most critical for risk management when you're dealing with something like SQQQ.
I agree. This is a big one. To fully serve an expert user, the critical warning about volatility decay requires a more detailed technical explanation within the risk assessment section.
The report does have an essential warning. It's under the trap section. It says the long-term trend is still down. SQQQ suffers from volatility decay. And it concludes with the very firm directive, do not marry this stock.
Which is mandatory advice for any leveraged product. It's great advice.
Absolutely.
But the weakness is in the execution. Just stating the term volatility decay without briefly explaining the mechanical implication, it assumes the user is fully aware of its specific operational risk.
It kind of weakens the report's completeness, doesn't it?
It does. We know the expert user is here for the detailed why behind the risk, not just a surface-level warning.
And if the report is calling for a sharp directional move, it absolutely must articulate what happens if that move doesn't happen. The user has to understand that sideways action isn't harmless.
It's not stagnation.
No, it's a guaranteed loss mechanism for this specific instrument.
Exactly right. So the suggestion for improvement is to integrate a concise explanation of the mechanism behind volatility decay and link it directly to the risk of the Nasdaq going sideways or choppy.
This would transform the warning from, a generic caution
into a specific technical constraint that's inherent to this very trade setup.
So let's get concrete. How would you do that?
Well, for some examples, the report needs to focus on the key feature of a leveraged ETF, that daily resetting of the leverage ratio.
That's the core of the issue.
That is the critical piece of information. It should explicitly note that the daily reset of the leverage, that 3x factor, is what structurally causes capital erosion when the Nasdaq lacks clear direction. It's not a slow leak.
No.
It's designed to grind capital down during consolidation.
And explaining that reinforces the logic of the trade itself. It proves why the trade needs to be quick and decisive, and why sideways movement is essentially death for SQQQ. It explains the trap.
And this directly validates the risk parameters you already set. By detailing the technical mechanism of decay, you logically explain why that $65.50 stop loss isn't just some random support level.
Right. It's an essential exit.
It's an essential exit required if the market stalls. The trade isn't just stopped out by price, it's forced out by the instrument's own mechanics.
That focus on the structural risk inherent in the vehicle itself is just so crucial. It shows a command not just of market direction, but of the instrument mechanics needed to execute this kind of trade safely.
It elevates the warning from a generic disclaimer to an essential part of the trade execution plan.
It really creates a comprehensive risk profile.
And the report is fundamentally strong. The entry and exit points are excellent. So, by integrating these three improvements, aligning the tone, quantifying the catalyst, and deepening the explanation of decay, the report moves past being a strong trading signal.
And becomes
It becomes a truly authoritative financial piece, truly suitable for that expert audience it's aiming for.
So, to quickly summarize the high-level critiques we've covered, first, align the presentation style with the sophisticated substance to maximize credibility.
Right?
Second, deepen the causal analysis. Give some quantitative context for the Oracle Catalyst's impact on the whole Nasdaq. And finally, provide much greater technical depth to that crucial warning about volatility decay in leveraged instruments.
That's the path forward. You've already built a great framework around very specific, actionable levels. That's $67.13 buy signal and the critical $65.50 stop. Focusing on the delivery and the depth of the causal and risk arguments will just make sure this piece is perceived as the professional, high-grade assessment that the core idea really deserves.
We are genuinely excited to see how these structural changes get integrated